I'm Lauren Hayes, and today we're talking about the Metrics Income Opportunities Trust, which is listed on the ASX under the ticker code MOT. Here to tell us more is Andrew Lockhart, CEO and Managing Partner at Metrics Credit Partners. Andrew, great to see you again.
Hi, Lauren.
So for viewers who don't know Metrics, can you tell us about the company and what space Metrics operates in?
Metrics is a business that we started back in 2013 when we launched our first fund. So my background and the background of my partners and an awful lot of the people that work at Metrics have been working inside banks. And so we're very much an active lender. So we look to provide financing, debt financing through the capital structure across a range of different funds to different companies. So we've grown our business now since June of 13 when we launched, where we originally launched with one investor that invested $75 million. Today, almost 13 years later, we're the largest private credit provider in the Australian market with over $35 billion of investments under management.
And so turning to Metrics Income Opportunities Trust, MOT, how do you explain what the trust does and what type of investor it's designed for?
MOT is designed to provide investors with access to private market investments, primarily debt investments. So we think that debt investments are a lower risk proposition than equity in a capital structure. And so what we're looking to deliver for investors is a regular total income of not less than 7% per annum from a well-diversified portfolio of debt investments. Now, that could be senior debt, it could be mezzanine or subordinated or junior debt to deliver a return to investors. And that return is generated from the fee income and the interest that is charged to borrowers. And so diversification, credit quality, and ensuring that we're delivering on that income is very important to investors. The one thing that's a little bit different about MOT is that MOT, we take the view that, when our investors provide the capital that will support the growth and the activities of a company, if we believe that that company is going to present an attractive investment opportunity, then what we try and seek to do is also provide our investors with exposure to potential upside through an equity or an equity-like investment. Now, that could be mezzanine, it could be a profit share, it could be options, warrants, or an outright equity ownership of the company or a project. And so MOT is really designed to be a hybrid vehicle, a mix of debt and equity. At the moment, it's around 60-odd% invested in debt investments, and the balance is held in a portfolio of equity investments, diversified across a range of property-related investments that we hold, retail investments, hotel investments, residential and industrial property development investments that we hold. We also hold some investments in privately owned companies, and so that provides a return. In fact, MOT unit holders actually have an interest in our business in Metrics as well.
And so MOT targets a cash distribution of around 7% per annum and a total return of 8 to 10% per annum, so net of fees through the cycle. How are you aiming to deliver that in practice?
So we've delivered in excess of the minimum target return to investors since the fund launched in 2019. So the returns come from primarily the debt investments that are held. And again, it's a well-diversified portfolio, over 260-odd investments in MOT. And then the total return or the extra return that we seek to deliver investors might come through high-yielding debt investments or from equity or equity-linked investments. So again, what we're looking for there is if we make an investment into a company, we're looking to grow with that company and deliver capital gain. We may hold that investment, receive dividend distributions, or we might exit that investment and hopefully sell the investment for a profit and deliver that as a yield to our investors. So it's an income fund. We're not looking to hold assets and benefit from the capital gain or growth. We're looking to trade the investment, make money for our investors, and then distribute that income to our investors. The equity investments tend to be held for a longer period of time than the debt investments. So MOT would sort of be seen to be a bit of a medium to longer term investment for people to really get the benefit of any potential upside that might come from the equity assets.
So when someone buys MOT on the ASX, what are they actually getting exposure to? Can you talk through the kinds of loans and opportunities you're investing in and what you mean by the full spectrum of private credit?
So the full spectrum of private credit is about investing across the capital structure. And so we take a view at Metrics that we want to build long-term, sustainable, strong relationships with companies in the market. And so that means that we're wanting to originate good quality assets with companies where we can do repeat business. And some of those companies might sometimes want a low-risk senior investment grade debt, in which case we might finance those through another one of Metrics funds. Sometimes those companies might be looking for mezzanine or junior or a subordinated debt investment that might meet the return criteria of what we're seeking to achieve for MOT investors. So I'll give you an example. A number of years ago, we completed a transaction for one of our clients, a property development group. We had previously provided senior debt against their property transactions where that met the return and risk profile for other funds of Metrics. On this particular occasion, we had the opportunity to provide a high-yielding mezzanine tranche to that facility. So again, I think in that case, the loan-to-valuation ratio was a few years ago was around 60%, and we were generating a total return of over 12% when interest rates were very, very low. And so it presented a very attractive return with a client that we'd done business with in the past where we were comfortable with the return. So the returns that are being generated for investors primarily come from the interest and fees that can be charged to borrowers, together with any potential upside from the equity exposures that we might hold. So we don't hold a huge number of corporate private equity investments. We're not looking for control transactions. So majority of those investments are minority, non-controlling interests in companies where we're hoping that those companies can grow earnings and grow value. We also hold a number of real estate investments, and some of those are operating assets where we're generating income from the rental income, looking to add value over time to those developments. Others are projects where we're financing the development of an industrial site, we're financing the development of a residential site, residential high density, or a large-scale land subdivision. And so what we're looking for there is to generate a higher total return from the success of the completion of that project.
So can you give it a simple real-world example of the sort of deal MOT might be part of and how investors get paid for it?
A good example would be, we've entered into a situation to provide debt financing to a company. A lot of those projects that are generating the return, or companies that are generating the return that we think are attractive for MOT investors, are focused on the real estate sector. And so that might well be, we're financing the development of a block of land into a land subdivision for residential purposes, or we might be undertaking a large-scale industrial project where somebody's bought the land, doing the civil works, the construction, the road works, and then selling the end industrial land. So they're examples. Equally, there are some situations where we've seen a company that we've provided financing to, or we've been asked to provide growth capital to the company to support the growth and the success of that company. It might be an early stage company that's generating, returns, but it has the opportunity in an attractive market to grow their business more. And so we might take a minority stake in those businesses to support the growth of companies, the growth in earnings, the growth in the value. Some of those investments, obviously, we have to monitor and control. So we look to take a board seat on those companies so that we can understand the performance of management, protect our investors' interests, and make sure that we're involved in the strategic direction and the way in which that company is operating in the market as well. So that we're not a passive investor. We're active with our clients on the debt side. When it comes to an equity investment, we look to make sure that we're protecting our investors' interests through active engagement on a board or with management to make sure that we're aligned around the strategy, the opportunity, and how that company is going to grow and succeed. And what we provide to those companies is access to capital, and that access to capital to support good management teams to be able to grow their businesses delivers good outcomes for our investors.
So many investors know MXT as the core income piece. How is MOT different in terms of the types of deals you do, the risk-return trade-off, and the role it can play alongside MXT in a portfolio?
That's right, Lauren. MXT is really designed to be the defensive alternative to traditional fixed income. MOT was designed to deliver a very attractive income, but a lower risk than an investor might be exposed to, say, in buying or holding a portfolio of purely equities in publicly listed companies. So when we look at it, we say the debt part of the capital structure will be a lower risk part of the capital structure than outright equity ownership. A lot of investors in the Australian market, given the floats of companies like Telstra and the Commonwealth Bank and CSL, have become familiar with equity ownership. And so one of the things they often do is they think that I'll buy a portfolio of shares, I'll receive the dividend distributions, and that's the way in which I generate income. But of course, the capital value of those investments can fluctuate materially because of the underlying performance of those companies. If they succeed and invest in good companies and the company's growing earnings, then those valuations might increase. But if really you're looking for a defensive sort of blue chip portfolio that's generating income, I don't think equity is really the asset class that delivers that stability. And so what investors were looking for in MOT was predominantly higher yielding debt investments that were generating an equity-like return. So through mezzanine debt, junior debt, subordinated debt, senior debt, to generate an income from fees and interest that's charged to the company, but not give up all of the potential upside. And so the exposure, as we've built out MOT, we've added additional equity investments. Now, often people sort of say, oh, I should be generating a higher return than 10% for my equity investments. What they don't realize is that that's part of a portfolio build out. You might not necessarily be generating interest income or fee income or receiving dividends because you're building out a portfolio. And what we've done in MOT is we've gradually built out the equity portfolio to between sort of 30-35% today. And so now it's getting to a mature level. Now what we want to see is those companies start to deliver on their return objectives and start to deliver higher total returns to investors. So it slightly changes the risk profile when you're invested in equity. But again, the vast bulk of MOT is exposed to debt investments, which are lower risk than the equity. And then on the equity side, not all of those are ordinary equity investments. They might be structured where we've got certain rights and protections that rank in priority to other shareholders.
So with that extra return potential comes more risk. So what are the main risks you're focused on in MOT and how do you manage them? Things like position sizing, security, covenants, and diversification.
All of those things are important. So you think about it, the biggest risk in a private credit investment is the risk of capital loss in the event of a default of a borrower defaulting under their loan agreement. And so a lot of companies, if you think about the capital structure, equity is the asset class that should be the one that absorbs the greatest risk of loss. If companies' earnings are volatile, the valuation of that company will be more volatile, but it should be at all times greater than the enterprise value of the debt. And so when we look at the debt part of the capital structure, it should be the lower risk position. So we do want to monitor the companies we lend to and take appropriate security, impose appropriate controls and covenants. So the covenants are really designed to ensure that we've got visibility around the debt service capacity of the company. Are they generating sufficient free cash to be able to service and repay their obligations? Have we got controls that the company can't change its business or it can't go off and make an acquisition or sell part of the company without a lender's control? Have we got controls around the balance sheet and the level of leverage that the company can take on? So that's what the covenants are designed to do, to protect a lender and give you an early warning as to any deterioration in credit quality. On the equity side, in the equity investments, it's about how's management performing? Are they delivering on the strategic objective? Are we monitoring our cost base? Have we got opportunities to grow in new products and new markets? What is going to drive the value for shareholders in that company? And how do we make sure or work with management to ensure that they're delivering on the objectives of the company? And so our mindset on the equity part of the portfolio is about control and monitoring the positions that we've got exposure to, but working with the management teams to execute on their strategy, giving good management teams access to capital to support their growth. Management teams that aren't performing, we want to make sure that we've got the ability to limit our downside position.
So in the current environment, where are you seeing the most attractive opportunities for MOT and are they being driven more by higher base rates, tighter bank lending or specific situations in certain sectors?
Well, one of the transactions we completed in MOT in July of this year, June, July of this year, was MOT actually owned some interest in two non-bank financial services businesses. So a business called Taurus Motor Holdings and a business called BC Invest. We as Metrics also had interest in non-bank financial services. And so we made an offer to the credit trust investors to acquire the interest in Taurus and BC Invest and to merge them into one business called Navalo Financial Services, which has become part of the Metrics Group. And so now investors in MOT have a look-through exposure to part of the performance and success and growth of Metrics as a business. So myself and my three other business partners hold the majority shareholding in Metrics. The National Pension Service of Korea and a group called Townsend are a shareholder, minority shareholder in our business, as is the ASX publicly listed company Pinnacle Investments, and the Credit Trust, being a minority shareholder, holds about 15%. MOT invests into the Credit Trust. So through that process, investors have gained exposure to the success and performance of Metrics as a group. So I look at the opportunity in private credit and think it's quite material. We think that we've got a great opportunity to continue to build out the small ticket consumer and small business lending activity within Navalo that will create good opportunities for our shareholders and our investors. And so I think that's an attractive opportunity for MOT investors. But equally, we're also very active in a whole range of real estate projects. And when you look at it, we've got increasing strong immigration numbers. We've got low unemployment levels. We've got relatively low interest rates. We've got a growth trajectory that's coming back. Inflation remains higher than expected, but really the demand for residential property continues to be very strong. We've got low vacancy rates, high rents. And so what we're doing as part of that is we're actively involved in lending and also made a number of equity investments across a range of different real estate projects that are designed to deliver high density residential housing to the market. And we think that's a pretty attractive opportunity for investors as well.
So what sort of time horizon should investors have in mind for MOT?
MOT is different to MXT. MXT is one where the investors are not expecting to gain much on the NAV. It's a portfolio of debt investments. They're looking to hold the NAV relatively stable and receive an income. In MOT, or our other listed vehicle of MRE, what investors are looking for is not only the income, but they also want to have exposure to higher opportunities, higher capital gain or higher levels of income. And so that naturally means that you would want to hold MOT or MRE for a longer period of time. So I would see those as being medium to longer term investments for investors to gain the full benefit of any potential equity upside.
Andrew Lockhart, thank you for the update.
Thanks, Lauren.